Analysis conducted by PwC on the future outlook of global wages indicates that several key emerging markets are fast losing their comparative labor market advantage. For the details of PwC's global wage projections to 2030, we have Gerald Seegers, the PwC Head of Human Resources for Southern Africa, and he joins us in studio. Gerald, thank you so much for making the time to join us. A very worrying outcome that we seem to be getting from this report. Why are emerging markets losing their comparative labor advantage?
Well, I think traditionally it's emerging markets who are now becoming consumer markets. But I think let's have a look at the study first of all, and get sort of built on the back of, we did a deep study in 2009 on the size of the global wage gap around the world, and then built from there. So from 2009 we then took the 2009, updated it to 2011 information based on the International Labour Organization, adjusted it for the IMF World Market Organization information. So we started with 2011 as a base year in terms of what is the average wage per domestic country, all based in dollars, and then projected that to 2030.
Right.
And that's showed a very interesting trend of those countries as to what their wages were looking like. And there we found that the emerging markets, as it tries to catch up to the sort of developed economies, it could have good and bad consequences for those economies. And interesting enough, the developed countries showed much slower growth in terms of their wage projections, and hence became, there was this closing of the gap.
Right. And what does this mean for global businesses then that are looking for opportunities in emerging markets?
Well, it's an interesting trend because it does kind of give us an indication where big global businesses, and particularly manufacturing, sort of labor-intensive organizations, will look to go to. Now, South Africa, or Africa for that matter, to a large extent has been kind of looked at a relatively low-cost labor. That, based on this study, is fast changing. So what we're seeing coming out of the study, countries like Brazil, China, Turkey, South Africa, some of the Latin American countries will move from a low labor cost jurisdiction to now a consumer jurisdiction. And then you've got countries like India and Philippines who stand out head and shoulders ahead in terms of remaining low cost. So if you're in the manufacturing area or in the construction area, that's probably where the big investment is going to end up going to. Okay,
so looking at investments, assuming on the back of these outcomes that foreign direct investment is likely to take a bit of a dip towards emerging markets?
Well, not necessarily emerging markets, but certainly those emerging markets who've got higher growth wages aspirations and real wages growth. What will happen is that gap will become, they'll no longer be low cost jurisdictions. Then we've got to look at, and South Africa is a good example, because we've got to sit back today and have a look, well, where are we going by 2030? Now, 2030 sounds like a hell of a long way to go to, but I think the question is, what do we need to do to change? What is going to change? Because inward investment is not going to happen if we're not going to develop something differently.
So how does South Africa and other markets that sit within the span respond, where we have growing strength of labor movement, and in particular unions, and then the back of this saying that this might see sort of foreign direct investments not coming into the country? How do you then respond to that?
Well, what we've got, effectively, we've got a growing middle class, not only in South Africa, but also in Africa. And it's growing, it's a quick and it's a big growing middle class. What will happen is those wages will increase. And then we've got to look at, well, where's the rest of the income going to come from? And again, Africa, which is the land of abundance, agriculture kind of stands out head and shoulders. The problem is that as you've got a growing middle class, they don't want to farm.
Right.
As they move from rural into cities. So there's a big opportunity now, I would say, for using agriculture as an example, but manufacturing could be history in terms of, unless we've got something else that's going to attract inward investment.
Of course, this is also good news for other people who are looking at this report and thinking, well, does this necessarily mean that income inequality in the country and in these markets, the gap there is being brought closer together?
Well, yeah, there's two parts to that question. Of course, it's still, unemployment remains a big issue. And that's the question, I think, in South Africa. If we could create more jobs, not necessarily at a higher wage, more people employed is better than a smaller group of people employed. Then so a lot of the focus on the wage gap is only looking at those that are employed, vis-a-vis the whole measure of Gini coefficient, which I really wouldn't like to go to, because then you've got to be an economist just to understand that. But basically, it's saying it's measuring, those that are making a contribution because of employment to the total economy.
Very quickly, before I let you go, productivity and this question of competitiveness. Is there a way of turning around that corner for South Africa where the increase in wages actually translates into an increase in productivity?
Well, we're quietly optimistic that South Africa will buck the trend, and that we could actually see increased wages, better parity and better equality amongst the workforce, and at the same time a significant improvement in productivity. And that's what we're looking for, better productivity, and in order to achieve that also means better education, better employment, and then there's a host of factors that need to come into play.
Quietly optimistic. We'll leave it on that note. Gerald, thank you so much for making the time to join us. Of course, we're speaking to Gerald Seegers, PwC Head of Human Resources.